Hey everyone, thank you so much for tuning in. I'm so excited about our topic for today. Today we are going to be talking about Iron Condors. I'd first like to welcome back all of our subscribers, and if this is your very first time here, a very warm welcome to you. My name is Kirk with Tactical Options Trading. We make videos like this all the time where we talk about the stock market and options trading, and I hope you'll consider subscribing and clicking that bell icon so that you don't miss out on any future content. All right, guys, let's get started. So we're talking about Iron Condors. What the heck is an Iron Condor? Well, an Iron Condor is an option strategy that involves basically 4 option contracts. And some key points to remember when we're trading Iron Condors is that an Iron Condor really is just a call credit spread and a put credit spread put together with the same expiration date. So all 4 options are typically sold out of the money, and because they're sold out of the money, we want those options to expire worthless. We want them to be worthless on expiration day so that we can capture all that premium that we collected when we sold that Iron Condor. So the call credit spread and the put credit spread are of equal width. So if we sold a $5 wide call credit spread, we'd want to sell a $5 wide put credit spread as well. So again, remember, this is a neutral trading strategy, but for us to really understand what an Iron Condor is, we need to understand what the basis is. So we're looking at a profit loss diagram right now of a short strangle. So a short strangle really has no protection on the upside. We have unlimited risk on the upside, and we have limited risk only by the stock going to zero on the downside. So if we sold a call and we sold a put, we really have no protection against the market moving outside of our short strikes. So when we sell an Iron Condor, basically we're just adding 2 legs onto that Iron Condor. So we're buying a protective call on the upside and we're buying a protective put on that downside, so it caps our losses. So if the stock did move beyond our strike prices, we're limited on our losses by those protective puts and calls that we have bought on the outside. So let's take a look at an example here. Right here we're looking at a $10 wide Iron Condor. So on the put side, we have a $10 wide put. Based off that, you can see here we sold the 40 and we bought the 30. We sold the 40 put and we bought the 30 put for protection. And on the call side, we sold the 50 call and we bought the 60 call for protection. So we have a $10 wide Iron Condor here. Now, when we are looking at this profit and loss diagram, we make the most amount of profit if the stock were to trade in this area right between our 2 strikes. Now as it starts to move down on the put side, or as the stock starts to move lower, at some point we have a break-even point here, but then as we get down around that 30 strike, our losses are capped by that 30 put that we bought that is now starting to make money, and it caps our losses. So on that upside, on the call side, again the same thing. We move up outside of our strike prices. Once we pass that break-even point, now we're at a loss. And once we hit that $60 call, that $60 call starts making money and it caps our losses on that upside. All right, let's take a look at how do we make or lose money on an Iron Condor. So when you trade an Iron Condor, our hope again is that the underlying security trades in a narrow range from the time that you open the position until the time the option expires. So when expiration arrives, if all the options are out of the money, they will expire worthless, and we'll get to keep all that premium that we sold when we opened up that Iron Condor. However, there's always a caveat, right? When we look at the stock market, we never know what the stock market is going to do. So if for some reason this Iron Condor blew up in our face and we had the worst case scenario, what's our maximum loss on this trade? So let's figure that out. So in the worst case scenario occurs when we're selling this Iron Condor, let's say on ABC security. If it moves so far that both calls, if it moves to the upside and both calls are in the money, or it moves to the downside and both puts are in the money, this would be on this trade, it'd be below 30 on the put side and above 60 on the call side. When option expiration arrives, then the spread would be worth the maximum amount, or 100 times the difference between the 2 strike prices. So what does that mean? So we all know that a contract is 100 shares of stock. So if we have to take that $10 wide strike distance and we have to times it by 100. So in this case, if we'd traded down and both puts were in the money, that'd be a $10 times $10 times 100, that would be $1,000 loss on that put side. Again, if it traded up above that 60 call and both calls were in the money, we'd have to take that $10 wide strike times 100. That would be $1,000 loss. But don't forget, when we sold that Iron Condor, we received a credit for selling that. So in this case, let's say we received a credit of $300. So in this case, we'd take that $1,000 loss, but because we received a credit, we'd add that $300 credit back in. So we'd have a maximum loss on this trade. If it was a $10 wide Iron Condor and we received a $300 credit, we'd have a maximum loss of $700 in this trade. So now I want to show you an example here. And a lot of people wonder, how is it called an Iron Condor? Why is it called a condor? Where does it get its name from? So what I have here is a profit loss diagram of a condor, but this is a condor where you're buying the condor. So you can see I have both a sold position here and a bought position, but we're just looking at the bought position right now. So you can see in this situation, we're looking at just the bought position. And when you buy an Iron Condor, it kind of takes on this little shape here. So we have one wing here, and then we have the body, and then another wing. So, you know, it's kind of a far stretch of the imagination, but this is an Iron Condor. This is a condor. It looks like a condor. You have the body right here in the middle, and then you got the wings. So that's where it gets its name, condor. So if we now look at, if we take that bought position off, let me just get it off our charts here, and we're going to look at the short Iron Condor. Now this looks like the profit loss diagram that we were just looking at on those earlier slides. So now we're just looking at the profit and loss diagram, basically a condor flipped upside down, and so this is where we get the Iron Condor. So that's how it gets its name. And again, we just went through this profit and loss diagram. You can see anything above the zero here is a profit on this trade, and anything below zero we start to lose money, and then we're capped at our losses. So in this case, on this trade here, we sold the 39 call and bought the 42 call as protection, and then we sold the 27 put and we bought the 24 put as protection. So we're looking for the stock to trade between 39 and 27. So what I want to do now is just pull up the same chart, and we're going to put those on the chart, the 39 and the 27 positions, and we can see what kind of a range an Iron Condor gives us here. So the 39 on the upside would fall about right in this area here, and 27 on the put side would come in about right in this area here. Now let's say we sold this Iron Condor and we have an expiration date of just somewhere in the future. We're going to call it right here. So anytime in the future we want this stock at expiration, at this line here where expiration is, let's say in this example it was October 15th. Let's say that this stock traded in this range, and on expiration day it was anywhere between these two strikes, we would have made our max profit. Now let's say that the stock had moved and traded and somehow ended up outside of our upside call that we sold, but then came back down in right before expiration. Again, we'd receive our max profit on this trade. Same thing, if it traded down below and we were down here, and even if it traded outside but came back in, as long as we're above that 27 put at expiration, we've made our max profit on this trade. So I love the Iron Condor. I think it's a great trade if you're especially looking at a neutral market or a market that's just kind of in a sideways chop. It's a good option to take a look at. So anyway, I really like that Iron Condor strategy. And guys, I hope you found this video helpful. If you have, like it or not, please leave some comments down here in the comment section. I'd love to hear what you think, and even know if you've traded an Iron Condor yourself. But if you've enjoyed this video, please give it a thumbs up and subscribe. We love putting these videos out, and we hope you enjoy them too. My name is Kirk with Tactical Options Trading. We'll catch you next time, and thank you so much for watching.